Welcome. Today we are tackling a massive change in the UK tax system called Making Tax Digital. Now, if you're self-employed or you're a landlord, you're definitely going to want to pay close attention because this is set to completely change how you handle your taxes. So let's cut right to the chase. Is your classic once-a-year tax return about to become a thing of the past? Well, for millions of people, the answer is a resounding yes. It's being replaced by a brand new digital system, and we're about to break down exactly what that's going to mean for you. All right, so here's how we're going to do this. First, we'll cover what on earth MTD actually is. Then, we'll get into who's affected and the key dates. After that, we'll dive into your new responsibilities, the completely new penalty system, and finally, we'll talk about the soft landing period and who might be exempt. Let's jump in. Okay, first things first. What is Making Tax Digital? Because, this isn't just some small update to a website. It's a fundamental shift in how you're going to interact with HMRC from now on. So, what it all boils down to is this. Making Tax Digital is the government's plan to get rid of that annual self-assessment scramble. Instead, you'll have to keep all of your records electronically. And, this is the big one, send summary updates to HMRC every 3 months using special approved software. So, why are they doing all this? Well, the main driver for HMRC is something called the tax gap. That's the difference between the tax they think they're owed and what they actually collect. They're betting that by pushing us all to keep digital records in real time, it'll slash the number of errors people make. But what's in it for you? Well, the idea is that you'll have a much clearer, up-to-date picture of what your tax bill's looking like all year round instead of getting a nasty surprise every January. Okay, so this is probably the most important question on your mind. Does this actually apply to me, and when do I need to start worrying about it? Well, it all hinges on your income. So let's take a look at the magic numbers. In the first wave, Making Tax Digital for income tax is coming for all self-employed people and landlords who have a total qualifying income of over £50,000 a year. But it's not going to stop there. That's just for starters. The plan is to lower that threshold down the line, pulling in anyone with a qualifying income over £30,000. And this is an absolutely crucial detail. What exactly is qualifying income? It's your total gross income, and that means before you've taken off any of your expenses from all of your self-employed work and any property businesses all added together. So for example, if you make 30 grand from your freelance work and another 25 grand from a rental property, your qualifying income is £55,000. You're in. All right, so let's say you've crossed the threshold and you're officially in the MTD club. What do you actually have to do now? Let's walk through what a year is going to look like under this new system. It really comes down to these 3 things. First, you've got to keep digital records. Paper ledgers are out. Second, you'll be sending 4 quarterly updates to HMRC throughout the year. And third, at the end of it all, you'll submit one final declaration to tie everything together. So you're moving from that once-a-year panic to a more constant, rolling process. And this table right here, this is the new rhythm of your financial year. Forget that one big deadline, now you have 4 smaller ones. As you can see, for every quarter, your update is due by the 7th of the month right after it ends. It forces you to stay on top of your finances, which, in theory, should make managing your cash flow a whole lot easier. But hey, here's a little bit of good news for anyone who hates change. That final end-of-year declaration, the one where you add in things like savings interest and make any last-minute tweaks, that is still due by the same old date, January 31st. So while the quarterly updates are new, that final deadline isn't going anywhere. Okay, a new system means new rules and, of course, new penalties. Let's talk about what happens if you're late, because it's a complete redesign of how HMRC deals with missed deadlines. So, get this. The old world of the automatic, no questions asked, £100 fine, it's gone. Instead, MTD brings in a 2-part system. For late filing, there's a new points-based model, which is actually designed to be a bit more forgiving for one-off mistakes. And for paying late, there's a new graded penalty system that gets tougher the longer you take to pay. So how do these points work? Honestly, the best way to think about it is like getting points on your driving license. For every deadline you miss, you get 1 penalty point. But you're not fined right away. You only get hit with a £200 fine once you rack up enough points to hit a certain threshold. And here are those thresholds. For your regular quarterly updates, the magic number is 4 points. So you could actually miss 3 quarterly deadlines without a financial penalty, but if you're late a 4th time,
Boom, that's when the £200 fine kicks in. But for that big annual final declaration, they're much stricter. The threshold is just 2 points.
Now, let's talk about paying late. The system does give you a bit of a grace period, no penalty if you pay up within 15 days. But from day 16 to day 30, you're looking at a penalty. And if you go past 30 days late, that penalty basically doubles and a much higher daily interest rate starts ticking up. The message here is pretty clear. HMRC wants you to pay on time. Okay, I know this all sounds pretty intense, but there is some breathing room built into the system. So let's talk about this soft landing period. And, importantly, who might be able to avoid this whole thing altogether.
And this is so important to understand. To help everyone get used to the new way of doing things, there's a soft landing period planned. For the first year of this new penalty system, which is currently set for the 2026 to 27 tax year, HMRC won't actually charge you a financial penalty for being late with your quarterly updates. Now, you'll still collect points for being late, so you can't ignore it completely, but you won't get that £200 fine. It's really just designed to give everyone a year to get into the swing of things.
Of course, not everyone is even in this boat. If your qualifying income is below that threshold we talked about, you're automatically out. These rules also don't apply to limited companies or to most partnerships. Trustees and people without a national insurance number are also exempt.
And beyond those automatic outs, you can also apply to be excused from the whole thing. So if for some reason you can't use digital tools, maybe because of your age, a disability, because you live somewhere with no internet, or for religious reasons, you can actually apply for what HMRC calls a digital exclusion exemption.
So, to bring it all home, let's circle back to the main idea. Just like HMRC says right here, the whole point is to shrink that tax gap by making our record-keeping better and our submissions more accurate. It really is a huge technological and, frankly, a behavioral change for all of us. This move away from a single yearly deadline to a constant cycle of digital records and quarterly reports is a really big deal. So I guess the real question that this all leaves us with is, now that you know what's on the horizon, are you, and is your business, truly ready for the change?